I'm Ben Reppond. Welcome to my YouTube broadcast. Today is March 15, 2023. I will cover, these are my market insights, my commentary on the markets. And all of this comes from the previous week and through Friday, the 10th of March. However, Monday, the 13th of March, following the Silicon Valley Bank debacle, and things are really going pretty wonky in the market, up and down both. I'll make some comments about, as of today, being Monday when I'm recording this, some things that I observe happening as it relates to what happened through Friday. So giving you the most current update that I can. So we'll begin with the dashboard. You can see that through last week, it was a very negative week in the market. And now we see, these are the 6 indexes that I follow, equity indexes, and the long-term government bond index, measured by the ETF TLT. And those are ranked from best performing to worst performing in the orange box year to date. That's the orange box just right in the middle of the chart. The yellow box is what occurred last week. That's the last week period, and then the second is the year-to-date period. On the right side are the dots. These are just a very simple indication of, is this index above or below its 20, 50, 100, 200-day moving averages. And if they're above, it's a green dot. If they're below, it's a red dot. So you can see for the last week, everything was negative, quite a bit negative, except for bonds. Long-term treasury bonds started to move up, and they moved up nicely. It looks like even this morning, Monday the 13th, they're continuing to move up. So that's a positive sign for bonds. But equities were quite a bit down. Equities had been up, some of them up quite a bit during the first part of the year, but those gains are starting to be eroded. And you can see, other than that second line, which is the government bonds, the rest of them are almost all red or all negative, below all of those moving averages. And then I drew a white line under the S&P 500, just so you can see that as a benchmark. It was down 4%, 4.5% last week. And year-to-date is about break-even, above a positive 0.9%. The most positive is the NASDAQ 100, the growth stocks, tech stocks, and the most negative is the Dow, the value stocks, the old economy stock called the blue chip stocks. And it's at the bottom. That was reversed last year when they were all down, but the Dow was losing the least by quite a bit. And the NASDAQ 100, which is on top now, was at the bottom by quite a bit, but they've changed places. So kind of on January 1, things shifted. So then if we go to, and this is through Friday, then here we break the S&P 500 down into its 11 sectors, and this is what the sectors look like. Again, when you see the right side of the chart, a lot of red dots. A lot of the sectors are below their moving averages. The only one that is above 3 moving averages is XOK, which is technology. And then you've got industrials and basic materials above their 200. Everything else, negative. You can see, like we did in the last chart, you can see the yellow box highlighting the losses from last week, going from a low of about 2% all the way down to, or a loss of 2%, with real estate going down 7%. The orange box is the year-to-date numbers. So those go, the winners mostly are technology, consumer discretionary, and retail. And then after that, it drops off, going from slightly positive all the way down to healthcare, which is negative 8% year to date. Again, consumer staples, XLP and XOV, healthcare, were at the top of the list. They lost the least last year. This year, they lost the most. Okay, this gives us a one-year line chart, weekly line chart, showing the movement of the S&P 500 over that one-year period of time. As you can see, it went up and down a lot. Generally speaking, because the black arrow cuts through it, generally speaking, it's down. It's in a downward trend. And the 20-period moving average is cutting through the data all the way through. It's trying to go up, but it can't. The bears and those who are shorting are pushing the market down. So, I'm sorry, this is a 15-month chart, not a 12-month chart. Next, another 15-month chart. This shows the S&P 500 growth stocks relative to the value stocks, because inside the S&P 500 are both. There are plenty of both. And when we chart that, and that's by the relative strength of a SPY-G versus SPY-V. When it goes up, that favors growth. When it goes down, that favors value. So you can see, again, over this 15-month period, the general direction is down. But if you look at the short-term period, beginning in the beginning of 2023, short-term growth is starting to go more into favor than value, which means it is moving slightly in an upward direction. This, I don't know, I didn't know what to do with this chart. This is the Russell 2000 Small Cap Index, IWM, relative to the S&P 500. So you have the small cap stocks relative to the large cap stocks. When it goes up, it favors small cap. When it goes down, it favors large cap. But you can see for the last year, back to the beginning of 22, I put a box around it. I didn't even know how to draw a line. It went up and down. And so I guess you'd say it's slightly favoring small cap by tilting up a little bit, but mostly it's just back and forth, pretty indecisive that small cap or large cap is not outpacing the other. When in fact, during the 2021, you could see that large cap was clearly in favor because it was declining. Long-term government bonds are still in a downtrend, although you can see for the last 5 months, they have been trying to go back up and have had, as you saw earlier, generally a positive period, which is causing that little tick up at the end. So generally, long-term bonds or government bonds are trying to trend upward, and but I don't know if that's enough to call it a trend or not, but I'd say the general longer-term trend is down still at this point, and that's a 32-month chart. The dollar went up a lot up until about 5 months ago, and 5 or 6 months ago, and then it started a downward trajectory. It is still kind of in a downward trajectory, and that's a 20-month chart. Gold, now this is interesting. Gold has started to move up and had a positive week last week. The week before was positive. And I'm going to comment this morning, Monday morning, gold is up about 2%. About 2%. So it's a big move for one day. And so that is and why is that? I think there is a seeking of a safe haven for assets because of the Silicon Valley Bank debacle and just the rattling and the uncertainty in the market. And so again, precious metals are looking favorable at this point. Silver, now this is really odd to see silver go in an opposite direction from gold. Sometimes silver will outperform gold, or sometimes gold will outperform silver. But generally speaking, they tend to move in the same direction. But this time silver moved down and showed weakness, and it's a 12-month chart, definitely below its 20-period moving average. However, this morning, silver was up 6%. in a day. Not even a day, a fraction of a few hours. Silver was up 6%. So when you see this chart next week, you're going to see this big spike up in silver. And then the next chart shows the relative strength of silver to gold. And because silver was down last week, gold was up. This caused the relative strength of silver to be weaker than gold, pushing that down quite a bit. This week, with silver being up and up quite a bit more than gold, this is going, if it continues this week, will probably push this quite a bit higher, both silver and the relative strength chart quite a bit higher. So silver is coming back into favor, at least as of today. So we shall see how this will develop. But I think there's a lot of uncertainty in the market right now, and the equity market, and because of that, money is looking for a safe haven, and I think this is probably, that's what that tells me. It was interesting, my son Spencer sent me a chart today, some data that showed today, this is Monday, March 13, there were about 20 stocks on the New York Stock Exchange where trading was halted. I recognized some of those names and some I did not. Halted. Wow. The New York Stock Exchange. What is going on? There is a lack of liquidity. I would say, I'm guessing that's the reason in the market. I don't know if these were companies that were in free fall or what, but it's something. It's either liquidity or going down rapidly or something. It's unusual to see companies where trading is halted. I'll learn more about that this week, really what happened. Bitcoin, the same thing happened with Bitcoin today. It's been in a downward trend. Okay, it tried in January to go up. It had a nice move up, and then it's been trending down since that time. Today, Monday, it is up 20%. When I looked, it was up 20%. So that big move up, and there was a lot of volume. So I would suspect that Bitcoin is going to be on the move up from here, but we shall see. Volatility index, because of the negative week, particularly the last 3 days of the week, it pushed the volatility index up, even enough to go above my mark of 24. So if that continues on up, when it goes above 24, it tends to keep going higher. So that's usually the beginning of a period when we're going to see higher volatility, which means negative equity prices. Asbury Research, their research last week was negative most of the week, and so as of Friday, no surprise, every indicator from Asbury was negative. They do a cross-asset relative performance chart showing which components, assets, are stronger than others. Now, they could both be down, so one would be down the least. They could both be up and one would be up the most, or one could be up and one could be down. So a variety of reasons, but just showing strength of one asset versus another. And this shows bonds versus equities. No surprise based on the data I just showed you. Bonds are in favor over equities at this point, both in the three columns, the last week, the last month, the last quarter. Large cap is in favor over small cap. And again, you saw that from the previous relative strength chart of IWM versus SPY. Technology is in favor over the broad market by quite a bit. Again, you saw at the indexes, the top index was the NASDAQ 100, heavy tech weighted, and the bottom one was the Dow, the blue chip stocks. So no surprise there. And of course, what that means is growth is in favor over value. And developed markets are more favorable, and you'll see that in my next chart. developed markets are more favored than emerging markets. In the bond area, government bonds are doing best over corporate, and corporate bonds are doing better than high yield junk bonds, and long-term bonds are doing better than short-term bonds. So these are big changes from what we saw last year. The U.S. versus the world. It's been a long time since we've seen the U.S. in a green box. We still don't see it. But we are seeing, these are the countries that are showing strength versus the U.S. And this is measured by their exchange-traded fund in the second column versus SPY. So on a relative chart basis, are they strong enough to get a green box? And you can see lots of them, including a lot of them in Europe, for example, and the Eurozone, all positive, plus Chile, Japan, Taiwan, UK, and Russia, and the Pacific. So, and the rest of them are Europe, all stronger than the U.S. So I thought I would do this. I've done this the last few weeks. I do a relative strength chart showing the Eurozone, and the ETF is EZU, divided by SPY, so relative strength. And you can see since really, I guess 6 months now, since mid-September, that the direction relative to each other, now they may have gone up and down, but the Eurozone is showing countries, generally speaking, in the Eurozone are much stronger than the U.S. And I'm not sure why. That continues to be the case. But when I think of the U.S. right now, it's a weaker economy, and Europe has got its problems, but it is, from an equity standpoint, is showing more strength than the U.S. Okay, precious metals. This is as of Friday. Does not include the comments that I just made about silver and gold. And gold, $18.69 per ounce. Silver, $20.56 per ounce. Silver is down 3.4%. Gold is up slightly, 0.6%. Now, one of the things that this is a new item that I'm covering, is the gold-silver ratio. People who are into precious metals understand this, and it is the price of gold divided by the price of silver. That ratio today, as of Friday, was about 91 to 1. That favors silver. So silver is a good buy at these kind of prices. It has been down in the 70s, and with this recent decline of silver, it has pushed that ratio, and the strength of gold, it has pushed that ratio up to 91 to 1. It's very unusual to see it this high. Historical averages, I think, believe it or not, I think the historical average is about 31 to 1, the ratio. So anything up in anything, in my opinion, above 70, long-term favors silver. During the, I think it was the pandemic in March of 2020, I think the ratio got above 100 to 1. Okay. He's in his happy place. I don't know if I could show you a cartoon that would better depict the market. Okay, thank you for watching. If you have comments, leave them in the comment section below, and I will try to answer them. Thank you.